On Business Incorporated today. South Africa's stock exchange suffers 5-hour outage. Egypt seeks partners for $2.5 billion energy project. Malawi now heads Southern Africa Development Community. Hello and welcome to Business Incorporated on Channels Television. I'm Ini John Mekwa. Well, let's start with intraday markets in Africa. It was negative trading on the African continent. The highest loss was in South Africa. The index lost 2.3%, and this is after the 5-hour glitch at the Johannesburg Stock Exchange. The NGX of Nigeria was also down 0.20%, while Egypt shared 0.56%, and Kenya closed negative. Also, the Osha index lost 0.82%. Now let's see a little bit of what happened in South Africa. The system at South Africa's oldest and largest exchange, NASPA Limited, and Perseus proved unable to process deals stemming from massive share rout. The transaction changed the weighting of companies on major South African indices, forcing wealth managers to adjust their portfolios. The heavy trading that followed paralyzed the stock exchange operator for about 5 hours. We have our correspondent now joining us from Johannesburg. Brian Pugeni joins us to tell us how that is going on now. Hello, Brian. Good afternoon.
Good afternoon, Ini. How are you?
Great, and you? So, Brian, what's the update now after the outage? Power has been restored and trading is on, but a whole lot of transactions were left behind. What's going on in the markets now?
Well, there was a 5-hour outage yesterday from.
Hello, Brian. Hello, Brian. Hello, Brian. I think you have someone. We can barely hear you because someone else seems to be talking around you. Could you help deal with that?
Can you hear me now?
Can you hear me?
I can hear you. Can you hear me now, Ini?
Yes, I can actually hear you, but someone else seems to be talking around you, and so that is distorting our communication.
As you just said?
There is no one here.
Okay. All right. So what's going on at the stock exchange now?
Well, the stock exchange finally did open yesterday afternoon, but it opened very late. It opened at 2:30 p.m., which is very late for trading. We saw traders not really happy with what happened. Traders were very worried, some even taking walks. Some spent the whole day looking at their screens, which is not a good thing for traders and brokers, and they really did lose a lot of business. But the stock market today opening very low. We saw the Outage index dropping today. Very, very low. But we're back online. But JSE, not a good look for JSE.
Can we quantify the costs of the glitch, amount lost for this 5-hour period?
Well, at the moment, we can't really quantify how much has been lost, but it should be a lot of, it's in the millions and billions, because a lot of companies could not trade, brokers, investors. It was a standstill in the Johannesburg Stock Exchange, as you can imagine. It's Africa's largest stock exchange, and people are not trading. A lot of companies did lose a lot, and investors did lose a lot, but we cannot quantify at the moment. But we're seeing the market very volatile. The rand today trading at over 15 rand, which is its lowest since March. We've seen signs of its recovery. But now we're seeing that impact already.
So have the authorities spoken about how to forestall a reoccurrence of something like this?
They are not really saying what they are going to do going forward. We know that is the broker-dealer accounting system, which is the main cause of the glitch. And some people are already calling for more opportunities and competition to the JSE, saying we can't have only the JSE controlling all the broking, all the getting. So the authorities are not really saying what's the way forward at the moment.
All right, well, thank you so much, Brian. Now we'll just stay on top of that story and see what they do, at least to forestall a reoccurrence of this kind of a thing. Thank you so much, Brian, and enjoy the rest of your day.
Thank you, same to you.
So let's move over to the Middle East now. It was also negative sentiment. It spread to the Middle East. Most of the markets were trading in the red as intraday. Abu Dhabi lost almost 1%, and this was closely followed by Dubai, which was down 0.83%. Elsewhere, Saudi Arabia went deeper in the red, 1.37%. And Qatari index was the only market in the green at intraday, 0.34%. Let's go to Europe now, where markets sank this morning as investors digest the latest Federal Reserve minute. The Pan-European Stock 600 traded 2% lower in mid-morning deals, with all sectors in the red. Basic resources, household goods and retail led the sectoral losses shortly after bourses opened in Europe. The CAC 400 in France was down 2.8%, followed by the FTSE 100 in the UK, which was off 2.1%. Well, we have Conrad with details from Frankfurt. Hello, Conrad. Good afternoon.
Good afternoon, Inni. One piece of good news is no glitches at the Frankfurt Stock Exchange today.
That's very good. That's a very good one, because a lot of money is lost with 1 minute of a glitch in a stock exchange. I mean, that's... But anyway, share prices are falling in spite of the fact that there's no glitch there all over the world, not just over there in Asia as well. What's the problem? It's not a glitch thing.
No, it's not a glitch, but the problem, I'm not sure whether it's really a problem or whether there's good news behind this. The news is that, as you mentioned, the minutes of the last meeting of the Federal Reserve monetary policy makers in the United States speak more loudly about tapering, about eventually a reduction of the very, very generous money supply or monetary policies by the US Federal Reserve. These monetary policies were introduced in recent years, first and foremost during the pandemic-caused recession last year. So they are extraordinary emergency monetary policy. The fact that now more and more monetary policy makers in the United States think about reducing it means that we're getting a bit more back to normal, and that these monetary policy makers think that the American economy is actually robust enough to be able to live with a little bit less generous monetary policy. The negative effect on the stock market has to do with, the earnings outlooks, which are reduced somewhat for companies. If you have higher cost refinancing yourself, you have a little bit fewer earnings in the future. Another factor is that many professional investors, but also some retail investors, have leveraged their trades on the markets, which means they traded with borrowed money. So the outlook of less favorable loan conditions for these traders means that they take some of the risk off the table. All this is also good news for the US dollar, which means that the euro-dollar exchange rate has dropped to the lowest level in 9 months.
Well, talking about earnings season, the second quarter is coming to an end in Europe, and European stocks are trading not far from recent records. Now, what should investors be doing? What's the bottom line? Are the valuations, should they sell or should they buy at this time?
If we look at the price-earnings ratio, which is, the ratio between the expected earnings by a majority of analysts and the actual prices of company shares, then European stocks are relatively cheap, especially compared to American ones. The price-earnings ratio here in Europe, generally speaking, is 17. Here in Germany, it's even lower. For the German DAX, it's 14. If you look at the S&P 500 in the United States, the price-earnings ratio there is 21. So American shares are significantly more expensive than European ones. That said, I think it's important to know that analysts have a tendency of estimating earnings of companies too high. Sometimes, in some quarters, the discrepancy between estimates and the actual earnings of companies is 20%. If we take this 20% discrepancy, of course, also European stocks are very, very expensive. Now, that makes it, of course, more important for people who want to invest in the market or think about it, that their time perspective is very important. If they have decades ahead of them, the risk is reduced. The longer you invest in your company shares, the less risky they become. What's also always important to keep in mind, to never put all your eggs in one basket. You have to diversify, or you should diversify your portfolio so that you can live more easily when one share in your portfolio loses a little bit, at least for a while.
Well, interesting investment advice there. Well, let's turn to an interesting piece of corporate news now. Palantir, the security and data firm that's shrouded in mystery somewhat, has announced that it spent $50.7 million on gold. Why did they do this? What's the point?
Palantir wants to hedge the risk of black swan events. Black swan events are events that come as a surprise, have a major effect, and are often inappropriately rationalized after the fact, you know, with the benefit of hindsight. 9/11 in New York was a black swan event, and also, you know, many years ago, the failure of Lehman Brothers in the United States, that also was a black swan event. What often happens along with black swan events is that valuations of assets on the markets drop. On the other hand, gold is considered by many to be a safe investment, an indicated investment in risky times. And this is behind the thinking of Palantir. The gold bars of 100 ounces each are going to be stored in a secure location in the northeast of the United States. Also sounds very mysterious. That's according to securities filing by Palantir, which was issued last week along with the quarterly earnings report. And Palantir writes the company is able to take physical possession of the gold bars stored at the facility at any time with reasonable notice.
Well, having physical possession of that gold, I think that is part of the reason why they're so shrouded in mystery. Oh, thank you so much.
Absolutely.
Yeah. Thank you so much, Conrad, and enjoy the rest of your day.
Thank you, Ini.
So let's move to the UK now. Pubs will start running out of chicken because of staff shortages at suppliers and the pandemic. The British Poultry Council said it had seen production slashed by up to 10% among its members, and this is because of issues at farms and processing plants. Insiders called on the government to make urgent changes to the rules on overseas workers to plug the gap. It comes as consumers are being warned that there could be empty shelves in shops after a union said HGV drivers would go on strike over a pay discrepancy. Up to 1,500 small stores across London and the South East could face delivery shortages after Tesco handed some drivers a £5 pay raise, but less for others. Earlier this week, Nando's revealed that it had forced to shut almost 75 restaurants due to lack of chicken. It blamed the closures on the national shortage of HGV drivers, a staffing crisis, and the impact of pandemic, but sent 70 staff to help suppliers. Now, the bosses of Britain's biggest companies earned 86 times the average full-time wage last year. The median pay of a chief executive of FTSE 100 firm, the UK's blue chip company index, was £2.69 million in 2020, according to a high pay center, and that was down 17% from £3.25 million in 2019. That was before the pandemic. Meanwhile, at intraday, the all-share index was in the red, 1.69%. FTSE 100 in the same region, 1.94%, while FTSE 250 shared 0.89%. In the currencies market, the pound was down against the dollar, 0.44%. Against the euro, it was down 0.37%, and against the Japanese yen, 0.54%. We'll take a break now. When we come back, we have more stories for you. It's Business Incorporated on Channels Television. You're welcome back. You're still watching Business Incorporated on Channels Television. Well, on our commodities market updates now, we're talking about electric cars. Yes, electric cars in 2021. They've surpassed the previous year by 107%. reaching a record 2.1 million units from 1.8 million last year. The shift from diesel and petrol-powered cars are not only in the EV category, but also in the hybrid segment. This change in EVs is happening in spite of the COVID lockdown and the attendant economic recession. But we have Isaac Adekoye, now analyst at Financial Derivatives Company, to have this conversation and tell us what's going on with the EVs. Hello, Isaac. Good to have you again. Good afternoon.
Hello, good afternoon. Thanks for having me.
So
yes,
it's obviously a new order, a new normal now. This is a threat to the old one. What will be the impact of this on investments and markets?
yes, we have started to see in the electric vehicle market that a lot of the components that are being used are now manufactured in a much stronger and much sustainable manner. So there's a general acceptance of electric vehicles in that sense. The entire industry is starting to see that, okay, this is a sustainable thing that we can use moving into the future. Then you have countries like China who are now having government support for electric vehicles in that sense. So there's a lot of all these carbon credits and all these incentives that are now going into electric vehicles. And so because of all this, we're seeing a situation where these vehicles are becoming more affordable. Then you have historically all these stronger car manufacturing companies such as Ford and General Motors. Most of them are now announcing more electric vehicle lines. So there is a lot of more belief in that sense. In terms of the markets, we can now see that apart from technology, some of the best performing stocks so far up to date have been in that sector. So you have companies such as Tesla, such as NIO, such as even SolarWinds that have lines along the manufacturing of battery packs for electric vehicles. So that's probably what you're seeing. Investor sentiment, investors are probably looking and positioning themselves for the next phase of appreciation in that sense.
Now, you know, before now, in Nigeria now, I mean, because we have to look inwards. In Nigeria, we're talking about, you know, making cars in Nigeria. With this new development globally, what's the outlook? What do you see in the Nigerian scene?
Well, on the Nigerian scene, you can look at it and say that, okay, the rest of the world is pushing towards electric vehicles, but we have not yet gotten to that stage yet. So you cannot really expect to see much of that in that sense. But when you look at the fact that most countries who we export petrol and we export crude oil to are part of the push towards electric vehicles, then you can see that we may not be able to see electric vehicles on the roads in Nigeria, but we'll feel them in the foreign exchange sense. So for instance, our largest crude oil buyers are India, and India has also just accelerated plans to have electric vehicles on the road. So they've pushed that back to 2030. You have Netherlands and Spain as well. You even have America, who is a net exporter of crude, also saying that they want to even push down they're pushing it forward rather to 2030 to have more electric vehicles on the road. So you consider that 10% of Nigeria's GDP is from crude, while 90% of our foreign exchange earnings are from that. So if these countries are pushing towards a more electric car friendly economy, then you are going to see that we would feel that impact. We may not see these cars on the road, but in terms of Forex and the economy, we will feel this impact.
Okay, so in Nigeria, there are about 2,946 petrol stations, in contrast to 285,000 electric vehicle charging points in Europe. Do you see it becoming more expensive to maintain the petrol vehicle in the nearest future?
Again, you have to look at it sort of what is actually happening. So like I said, we're not ready for that electric car. We're not ready for that in Nigeria yet. But what you also find is across Africa, we're starting to see that more of these car manufacturers are positioning themselves in Africa to sort of cater to the African market. Yes, the rest of the world might be going green, but you need to understand that Africa is still a huge market. Nigeria is also a huge market. And so while these other companies might be positioning to serve Europe and the rest of them with electric vehicles, we're still going to see them manufacturing more of their vehicles in Africa. You can see in South Africa, we have BMW, we have Nissan, and also I think there's a plant being opened now in Ghana as well. And then you also look locally as well. You have the likes of Innocent, the likes of North, who might be able to actually meet the local demand if we get there. So while the rest of the world is probably moving that way, the realities of Africa means we are not actually ready for that yet. And there is still a market locally that we saw. I mean, you also have to look at, we are currently constructing a refinery to meet the West African needs and the African needs in terms of crude oil. So definitely Nigeria, we will probably see more of these manufacturers positioning in Africa to serve the needs of Africans.
Yeah, and yet we are endorsed in the Paris Climate Accord. But anyway, thank you so much for sharing your thoughts with us, Isaac, and I do enjoy the rest of your day.
Thank you.
So moving on now, we go to Egypt, where Egypt is seeking partners to invest a $2.5 billion initiative to build more than a dozen renewable energy plants by 2025 as the country tackles looming water scarcity. Population growth and climate change has made Egypt vulnerable to water scarcity. And according to the United Nations, the world must spend $6.7 trillion on water infrastructure by 2030. Egyptian officials are planning 17 new factories that would run on solar energy and other green resources, each built, owned, and operated by Egypt's State Wealth Fund in conjunction with a group of local and foreign investors. The Arab world's most populous nation depends on the River Nile for nearly all of its fresh water and faces a gaping shortage of supplies that officials fear will be exacerbated by a giant hydroelectric dam filling Ethiopia's main tributary. In Malawi, the country has taken leadership of the Southern Africa Development Community for the next 12 months. The president took control of the regional bloc from Mozambique's Filipe Nyusi at the 41st Ordinary Summit of Heads of State and Government in Malawi's capital. Mr. Chikara says Malawi is deeply honored to host the SADC summit, and the meeting is important as it comes at a time when the region has been hit by the COVID-19 pandemic. He has called for a focus on areas that could help the region register quick gains from the coronavirus to create jobs. And there may be further changes as proposed to the Public Finance Management Bill in 2021, and that would see Parliament approve the country's borrowings. This, the legislature argues, will ensure the borrowing process is transparent, necessary, and realistic, cushioning the country from the high debt obligation. The proposal will ensure that Kenyans get to know how money is borrowed, from who and why, how the money is used, and the payment plan. For instance, the MP wants the Cabinet Secretary, National Treasury, to seek approval from the National Assembly prior to raising any loan or guarantee. The new charges propose that any expenses incurred in connection with borrowing by the national government are charged on a consolidated fund or any other public fund set up in the CS and approved by Parliament. In South Africa, the Banking Risk Information Center has confirmed that at least 1,227 ATMs, and there will be 310 bank branches, were vandalized in the recent unrest in the country. It says during the 10 days of looting, about 119 million rand in physical cash was stolen. This amount does not include the cost of damage to banking infrastructure. Esabri says not all notes are dye-stained and millions will be injected back into the economy. Meanwhile, banks will likely have to rebuild almost 200 branches, and full recovery of physical bank infrastructure is expected to take a while. Still in South Africa, the South African Reserve Bank has tabled its 2020-2021 annual report to Parliament's Standing Committee on Finance and says the impact of the COVID-19 pandemic has been uneven on the country's industries, noting very slow movement on labor-intensive sectors. The SRB showed that employment in most sectors had declined, particularly in construction, transport and finance, with only the agricultural sector showing positive growth. The central bank says domestic growth was not high enough and weaker compared to its peers. The recovery to pre-pandemic levels will be expected around 2023. Well, that's it on the program today. Thank you so much for watching. I'm Ini John Mekwa.